SARS still has the right to tax us up to 45% tax on savings interest income. So first things first, how you can pay less or no tax on savings in South Africa using a mixture of 4 solutions. If you're new here, my name is Yvonne, and on this channel we talk about all things personal finance. And if you like this video already, please hit the like button. And if you haven't joined the free squad yet, please hit the subscribe button now. Let's get started. So now, how do we avoid or how do we pay less tax on savings interest income? You have 4 options, and the first one is to open a tax-free savings account. In South Africa, every single year you can save up to 36,000 in a tax-free savings vehicle, and your lifetime tax-free savings is 500,000. So to illustrate the power of tax-free savings and how you can diversify your savings by putting money in a tax-free savings vehicle and in a high yield savings account vehicle or a fixed deposit account, instead of putting all your money in a high yield savings account or a fixed deposit account, I'm going to use this example. So instead of putting 100,000 as we did in the previous example, say you took 36,000 in the first year, and that's your initial amount. And every single year you add an additional 36,000. Remember, you're not allowed to breach that. So you're going to be adding 36,000 annually, and assuming a nominal interest rate of 8.42%, which will be compounded monthly, and so the effective interest rate will be around 8.75%. The total future value in your tax-free savings account, which will not be taxed, is 627,634 rand. The total deposits that you are going to make over the 10 years are 396,000, and the total interest will be 231,634 rand. That's just over 35% in interest that you're getting tax-free. And so my suggestion, not financial advice, is to use a tax-free savings account and a fixed deposit or a high yield savings account together. So if you have a lump sum, take the full 36,000 and put it in your tax-free savings in the first year, and the rest put it in your fixed deposit or in a high yield savings account. And then every single year after that, try to max out your tax-free savings account. The interest rates will change over time as the repo rate changes, but if you put your money in a high yield savings account at the beginning, a high yield tax-free savings account at the beginning, then the reduction in the interest will not be as drastic. The second solution to paying less tax on your savings or no tax at all is to try to max out your retirement savings. Every year you have an allowance of 27.5% of your annual income, which should be a maximum of 350,000 rand per year. Now, the main issue with retirement savings is they come with their own costs. So you might not be paying tax, but you're going to pay management fees, and you're also going to pay financial advisor fees and other fees that your fund manager might have that could actually erode the interest that you're earning on a yearly basis. And so that's something to consider when it comes to retirement savings. However, you could use your employer match to offset some of these expenses so that it's not your money that's paying for the expenses, but your employer's money. Let me know if that sounds like a good solution, but that's how I've structured it in my life. The third solution to pay less tax on your interest income or to pay less on your savings, whichever you want to use, is endowments. Now, this solution only works for people who have a marginal tax rate that is above 30%, which means on your salary, if you're paying 31% and above, this could be a solution for you to limit the amount that SARS takes from your interest income on your savings. So say, like in the first example, you're in the 45% marginal tax rate, and you actually want to reduce your tax burden, you could buy into an endowment policy, and that guarantees that you will lock your tax rate at only 30% and not pay the 45%. But there's a caveat, there is no annual exemption. And so you'll be paying 30% on the total interest income, which is different to normal savings, where there's a threshold of 23,800. That's really important. And the other thing to consider is that there'll be additional fees because it's being put in mostly mutual funds and other savings and investment vehicles, which might come with a high expense ratio. However, in terms of tax efficiency, if you're only paying 30%, this is the most tax efficient way to pay less tax on your savings, or if you will, on your investments. And the beauty of endowment policies is that your beneficiaries will be paid out immediately. It doesn't have to go through the estate administration process that your other assets and liabilities, your other estate, will have to go through, which means it's not only tax efficient, but it's also good for estate planning. The last one, which I really like a lot, is investing. Because with investing, you pay what is called capital gains tax, but there's a 40,000 tax exemption, and you only pay 40% of the profits over and above the 40,000. And the beauty of it, capital gains tax is only triggered when you sell the investment. So instead of paying taxes every single year like with savings, with investing, you don't pay tax every single year. Dividends, on the other hand, you have to pay 20% tax. But when it comes to capital gains on your investments, you don't have to pay on a yearly basis. So the best way to incorporate these solutions is to pick two. So say a tax-free savings account and investing, and then mix it with fixed deposit accounts or high yield savings accounts. Then with your 100,000 initial deposit, take the 36,000, like I said, put it in your tax-free savings. Put whatever amount, maybe 50,000 or 20,000 in your fixed deposit or high yield savings account. And the rest that you don't need, invest in ETFs on either Brock stock or easy equities. I'm going to be talking about investing and what I invest in the next series, but find a way to mix your savings accounts with some of the solutions that I've provided so that you can diversify to reduce your tax on savings. What I do is max out my retirement savings, like I mentioned, and I have a tax-free share account that I invest through on easy equities. I also have a tax-free savings account for de-risking purposes. Then I also have a fixed deposit account and a high yield savings account. Please hit the like button if this has been useful. And if you haven't seen all the 11 high yield savings account options in South Africa, I'll link the video up here somewhere. And I'll also link the 9 fixed deposit accounts that I would put my money in South Africa in the other video, somewhere up here. Thank you so much for watching. I'll see you in my next one.